Hello, everyone. Once we will exceptionally make this interview in English in order to welcome Jan Christoph HERBST, coming from the German asset management MainFirst. Thank you very much for being here with us in Pareto.
Thank you for having me.
So as a portfolio manager, how do you manage the risk, especially in these difficult times that we know for the moment regarding to monetary policy and geopolitics?
Yeah, to be honest, we don't focus on those big bang events in the economy. That's not really helpful for us. First of all, we don't know exactly what the risks of the future are going to look like. And second, we do not know when those risks are going to appear to us. What we can instead focus on is identifying longer term developments that could threaten our portfolio. Just to give you an example, the European banking sector, we're not investing here anymore since 2009. Very good, difficult time European banks have had. Another example are the European technology-oriented companies. It doesn't look like, at least as of now, that Europe is being able to catch up with Asia or the US when it comes to entrepreneurship, for example. So it would be, not really careful focusing only on European investments. We need to take care of that risk. We need to have a more global portfolio, how we set up ourselves.
You're most stock picker.
Exactly. We're not macro strategists. We're more or less stock pickers. Yes.
Okay. Yeah. So as you know, the technology sector, including IA and robotics, has grown up very well this year after a very complicated year last year. So isn't it a good moment to sell it, to save the gains, and to go away?
Yeah, some people call it a good year. I'm not that sure if it was so good. Let's take the Nasdaq index as an example. We have a performance year to date of 35% plus, but we have lost 35% last year as well. So if you consider the base effect of that price development, we have not even reached the old levels of performance. That's one point. And second, over the time, we have seen a lot of devaluation, especially of growth stocks. If you have a look at our portfolio, for example, we are going more or less sideways for 2 to 3 years now. But companies we own, they have developed, right? They are making more revenues, they are more profitable than before, and valuations have come down. At the same time, interest rates have risen a lot. And we believe that further upside potential for interest rates to go even higher is quite limited. I mean, we have reached 5% interest rates in the US for 10-year treasury yields, for example, while having an inflation in the US between 3 and 4%. Further upside potential in the direction north of 6% or maybe 7%, like Jamie Dimon has said, is quite unrealistic from that point of view. You mentioned it regarding topics like AI. We have seen a big rush on that topics in many names, have seen a phenomenal performance. Just to name, to give you a very common example, maybe the best known one is NVIDIA. We're very long-term investors in NVIDIA already. We have bought our first shares in 2015, have had a great performance. We still believe in the business model. Why don't we sell it after 200% performance this year? I mean, what has happened this year after the rush on GPUs, those graphic chips that you can use for calculations regarding artificial intelligence? The revenue of NVIDIA has just doubled within 6 months. The guidance has been taken up by the management 2 times now. We're very excited what the next quarter is going to bring. And the company is probably in the third quarter making a profit of $3 to $4 per share. If the company could grow further into next year, maybe, I mean, it can. The order book is flooded by demand of GPUs for large data centers, for startups. So maybe $4 to $5 profit per share per quarter is possible in the next year. That means $20 per share in profits. The stock is currently trading a little bit above 400. That means a price earnings ratio of roughly 20 times. for a company that's industry leading with a long-term revenue growth of more than 50%. That's possible. It has nearly 100% market share in GPUs that are needed for artificial intelligence calculation, very high barriers to entry, and what we really like, the company is founder managed, a very visionary entrepreneur that's leading the company with a long-term vision. We feel really happy with the company, and the company got cheaper, even though the stock price has risen that much. That's why we are confident with AI to keep staying invested here and to see further upside potential in the stock.
So for the moment, you buy, then you sell not.
Exactly, we stay invested. We are confident.
Okay. Finally, Jan Christoph, regarding to you, what sector has seen the most dramatic change over the last month?
Yeah, maybe not over the last month, but maybe a little bit longer term. When we compare the situation today to last year, I would say the automobile industry has seen a dramatic change. What has the situation in the last year looked like? We have seen dramatic supply challenges when it comes to wiring harnesses, for example, or semiconductor chips for the cars. And it was basically a fantastic situation for car producers. Nobody really had to have discounts to the consumers, and the companies preferred to sell the more expensive cars with higher margins first. So the margin situation and profit situation was quite nice in the last year. The situation has changed completely this year. We are now seeing companies have to give discounts. Supply situation has improved a lot. Also, prices for raw materials came down a lot. Nickel, for example, copper or lithium for the batteries you need for electric cars, those prices came down a lot. But we have a problem now. We have a lot of different companies producing electric cars, but most of the legacy car producers are not able to ramp their production while producing profits. And as of right now, there are only two companies that can produce in scale and can ramp their production while also being profitable on that scale. That's Tesla and BYD. Yeah, they are producing a lot of their cars they sell in China, because China has amazing access to the raw materials, so to the batteries, and are highly effective when it comes to cost structure. So we are very careful when we want to invest in that structural trend, electrification of the automobile industry. But with those investments, we feel quite comfortable.
That's maybe why you are a global fund.
Exactly. We like a global distribution. We don't want to have too much overweight into one region. We have roughly 1/3 of our investments in Europe, 1/3 in Asia, and a little bit more than 1/3 in the United States.
And as I can understand, it's the same with the topics, with the themes. Technology first, maybe?
I wouldn't call it technology. We have our diversification. We could basically describe, we diversify the portfolio over several different investment themes. And those themes that have the highest weighting right now are semiconductors, for example, followed by cloud computing, followed by resources, for example, that you need for the energy transition. Then we have cars of the future. In other words, electric cars that have high impact on structural themes. And we complement that portfolio selection by more consumer-oriented investment themes. Luxury goods, for example, some very selective sporting goods companies as well. And by that diversification, we have quite a healthy balance of the portfolio that we can see.
Okay, thank you very much, Jan Christoph. Thank you for being here with us today, and see you very soon for the next Flash Market next month. Have a great day. Bye-bye.
Bye-bye.